Saturday, February 28th, 2026. If you've looked at your phone this morning, or even if you just walked past a TV screen in a coffee shop, you already know the atmosphere has shifted.
Yeah, it has.
Public reporting confirms the United States has launched military strikes against Iranian-linked targets. And this follows that trigger event involving a Gulf tanker we've been hearing rumors about all week. The news is everywhere, the hot takes are flying, and honestly, the anxiety is just palpable.
It is a really heavy morning. There's no getting around that. And usually when we sit down to do a deep dive, we are looking back at history, analyzing a trend from the 90s or dissecting a tech bubble from last year. But today, we are right in the middle of the fire. We're live in the event path.
Exactly. And that is why we are stripping away the political commentary today. We aren't here to debate foreign policy or military strategy. There are plenty of other channels screaming about that right now. Our mission in this deep dive is strictly focused on the market impact.
Right, because the data structure of how markets actually react to war is, well, spoiler alert, it's usually not what you think.
It really isn't. And we've got a stack of reports here to get through. But quickly, before we unpack the data, for those who want to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai. To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
And as always, especially given the gravity of what is happening today, we need to be clear about the ground rules. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated. Okay, let's get to the core question. The missiles are flying. Headlines are screaming. Does this mean the market crashes, or is it more complicated?
It's significantly more complicated. In fact, if you follow the logic of, war is bad, therefore stocks go down, you're probably going to be on the wrong side of the trade.
Okay, so walk us through the actual mechanics.
Sure. If you look at the research, a war that just happens abruptly, like what we're seeing today, is characterized as a two-stage shock.
A two-stage shock?
Yeah.
Is that just economist speak for it goes down, then it goes up?
Not exactly. It's more about what the market is trying to digest. Stage one is what we're experiencing right now this morning. It's the repricing of tail risk. That panic phase where energy and shipping risk premiums just spike because nobody knows where the ceiling is.
Right, because we don't know if this is a one-day surgical strike or a 10-year ground war.
Precisely. But stage two, that's the medium-term phase. And history strongly suggests that the crash isn't the default setting. Stage two depends entirely on escalation pathways, not on those initial strikes themselves.
So we're basically in the emotional adrenaline phase right now.
Essentially, yes.
Which brings us to something I found absolutely fascinating in the source material, this concept of uncertainty resolution. There's this finding from Oxford Economics that just, it feels completely backwards.
Yeah, it's one of those findings that makes you stop and reread the page. They found that volatility usually rises ahead of hostilities during the saber-rattling phase, the rumors, the leaks, and actually declines once the shooting starts.
I mean, you'd think actual war explosions, kinetic action, would be way more volatile than just the threat of war.
You would think so, but you have to understand the psychology of the market. Markets hate one thing more than bad news, and that's not knowing. They hate the unknown. Before the strikes, the possibilities are literally endless. Is it nuclear? Is it a minor drone strike? That is maximum uncertainty, and an algorithm cannot price infinite possibilities.
It's the waiting that breaks the system.
Right. But once the war starts, the unknown becomes a known. We know the strikes happen. We see the targets. Even if the news is terrible, it is defined news. That's uncertainty resolution.
The market can price in a war. It just can't price in a mystery.
Exactly. So you often see markets stabilize simply because the Band-Aid has finally been ripped off.
It's like a really grim version of sell the rumor, buy the news.
Unfortunately, yes.
The sources also mentioned something about safe havens. I assume everyone is rushing into the US dollar right now.
Yeah, that's the typical knee-jerk reaction. When people get scared, they want cash. Specifically, the world's reserve currency. The report notes the US dollar often sees safe haven strength, but here is the catch. It's usually short-lived. It tends to reverse later as the situation normalizes.
So it's a parking spot, not a permanent shift.
Right.
So the big takeaway here isn't that wars are bullish or bearish. It's that markets are essentially just pricing two specific things, energy disruption and uncertainty.
Exactly. If you strip away the emotion, the market is just a calculator. It's calculating the probability of oil supply chains breaking and the timeline of the conflict. Everything else is noise.
Let's look at the actual receipts because we have some serious historical data here. The Oxford Economics Event Study looked at 5 major U.S. attacks. Gulf War I in 91, Bosnia in 95, Kosovo in 99, Afghanistan in 2001, and Gulf War II in 2003.
And when you look at those 5, one of them stands out like a sore thumb.
Gulf War I.
Yes, 1991. That is the critical comparison for us today. In 91, equities fell about 8.2% in the first month. But look at oil. It rose close to 50% over 3 months.
50%? I mean, that's an economic heart attack.
It is a massive shock. That is your bad scenario. That's what happens when a conflict directly threatens global energy supply. But compare that to Bosnia or Afghanistan.
The report calls those the nothing burger conflicts in terms of market impact.
A bit harsh, maybe, but financially accurate. In the Oxford framework, conflicts with constrained enemy capacity like Bosnia were almost wholly irrelevant to market prices. The market just shrugged.
Just purely because Bosnia didn't produce oil and couldn't threaten global shipping.
Exactly. It was a humanitarian crisis, but it wasn't a financial one.
Okay, let's zoom in on the Stoop data. This highlights the difference between a surprise and an anticipated event really well.
Right. Let's look at the day zero numbers. The market return on the exact day hostilities began.
So for high surprise events, Pearl Harbor, day zero, the market drops 4.37%. Korean War drops 5.38%. Pure shock.
The algorithms break because the input wasn't expected. Panic selling.
But then look at Gulf War I again, the bad scenario for oil. But on day zero, the day Desert Storm began, the S&P 500 actually rallied 3.73%.
A nearly 4% rally on the day war started. That is the uncertainty resolution playing out. The build-up to Desert Storm was months long. When it finally started, the market just breathed a sigh of relief, like, okay, the uncertainty is over.
That is wild to think about, but we also have to be careful with longer-term data. The Afghanistan numbers look terrible on paper.
Yeah, this is the macro trap. You have to separate correlation from causation. 1 year after the Afghanistan war started in 2001, the market was down 24.84%. You might look at that and say, the war crushed the market.
But it was actually the dot-com bubble bursting.
Exactly, and a major recession. Context matters. The macro regime inflation, tech bubbles, recessions, that is usually way more powerful than the conflict itself. The war is a wave, but the economy is the tide.
Okay, so we have the theory and the history. Now, the multi-trillion-dollar question for today, February 28th, 2026. Is this moment more like Bosnia, where the market shrugs, or is it Gulf War I?
Based on the analysis in our source material, I'm afraid it leans much more toward Gulf War I.
Not what people want to hear. Why? What makes today different from the targeted strikes we've seen in recent years?
3 main reasons. First is retaliation capacity. In Bosnia or Kosovo, the enemy had very limited ability to strike back globally. Iran is different. They have a much higher perceived capacity to retaliate.
So they can actually punch back. The constrained enemy theory doesn't apply.
Right. Second, and this is the big one, the energy channel, this conflict is sitting right next to the Strait of Hormuz.
The ultimate global choke point.
Exactly. This hits the fat tail risk distribution for oil. You don't worry about 20% of the world's oil supply getting blocked in Bosnia. Here you do. That's a direct line to inflation.
And the third reason?
Modern risks. Cyber risk and infrastructure targeting. It's 2026. Wars aren't just fought with missiles. Cyber attacks on payment systems or power grids that increases the right tail of volatility. It introduces chaos we just didn't have in 1991.
Right. In 91, nobody was worried about the New York Stock Exchange getting hacked offline.
Exactly. So oil is king here, but cyber is the joker in the deck.
So simplifying this for you listening, oil is the swing factor. If shipping in the Persian Gulf continues, market moves should be moderate. If it stops, we get what the report calls nonlinear outcomes.
Fancy way of saying things go completely off the rails.
Off the rails quickly. Okay, let's look forward. The report outlines 3 scenarios for what happens next, which is a great framework for watching the news this week. Let's start with Scenario A.
Scenario A is the baseline, the contained conflict. Limited strikes, but crucially, no sustained disruption to shipping. Tankers keep moving.
What happens to the markets?
Equities might dip initially, but they mean revert. They bounce back. Oil risk premium rises, but stabilizes historically around 6.4% over 3 months.
Annoying at the gas pump, but not an economic crisis.
Right, and the VIX spikes, then fades, the market digests it, and moved on.
Okay, Scenario B, escalation in shipping disruption. The tail risk.
This is your Gulf War and repeat. Sustained disruption in the Gulf. Maybe the strait is mined, or insurance is pulled. Oil goes sharply higher. Equities go down, especially emerging markets. Credit spreads widen, meaning it's harder for companies to borrow money.
That's the nonlinear danger zone where it breaks the broader economy.
Exactly.
And Scenario C, de-escalation.
A credible ceasefire or rapid end. You get a relief rally. Safe haven flows reverse out of the dollar and back into stocks.
Okay, so for the listener sitting at home refreshing their feed, What should they actually be watching? Because every headline says crisis right now.
You need a specific dashboard. Ignore the font size on the breaking news banner. Don't even just watch the spot price of oil. Watch the front month versus deferred oil spreads.
Okay, plain English for us. Front month versus deferred.
It's just the difference between buying oil today versus buying it for delivery 6 months from now. Usually, oil in the future is more expensive. But if the price for now rockets past the price for later, traders call that backwardation.
Meaning there's a panic for physical shortage right this second.
Yes. Buyers are desperate for barrels today because they don't think they can get them tomorrow. That's a sign of real disruption, not just speculation.
Great distinction.
What else? Shipping insurance rates. Watch the premiums for tankers transiting the Gulf.
Because actuaries don't play politics.
Exactly. If insurers pull coverage or rates go vertical, that strait is effectively closed. If a ship isn't insured, the oil doesn't flow, regardless of what the politicians say.
That is a massive pro tip. Watch the insurers. This has been an incredible breakdown. We went from the psychology of panic to 1991 data to a roadmap for this week.
Keeping a cool head is key. The initial shock is scary, but long-term impact is driven by how the economy handles the energy shock.
Which brings me to a final thought for you to chew on today. The macro financial feedback loop. Think about this. Even if the shooting stops in 2 weeks, if oil prices stay high for the next 3 to 12 months, central banks have a massive problem.
They absolutely do.
They might have to keep interest rates high just to fight that energy inflation.
And that's the real danger. The Fed can't shoot down inflation with a missile. They do it by tightening the economy. So the military war might end, but the economic war could linger in your portfolio for a year.
The shooting war is fast. The economic war is slow. Well, on that sobering note, stay calm, don't trade on headlines, and keep your eye on the oil spreads. Stay curious.